Hey guys, I just want to do a quick video today about what I've been seeing in the markets as well as the economy. So the most recent news item that we've been seeing is the non-farm payrolls at 467,000 new jobs being created in the US in January alone. That is huge, considering the fact that they have only estimated 150,000 on all the major banks. So we've beaten that estimate by more than double. So that's pretty crazy. Now, why is this concerning? Well, it's because this guarantees the rate hikes are coming for the Federal Reserve. Now, I'm going to quickly jump into the chart to just show you what's been happening with the rate cuts at the crash of 2020 and what happened after they cut the rates. And we can see, I'll just quickly bring up the charts, what happened there. And we have had a massive rise up from 2,200 all the way to 4,800, nearly 5,000, more than doubling of the stock price in practically a straight line, as you can see. That's what happened when they cut the rates and started the asset purchases. In other words, buying bonds from the government and flooding the whole market and economy with liquidity. Now, they're going to be forced to do the opposite with inflation, right? Federal Reserve has two mandates. One is price stability. Two is maximizing employment. Now, their mandate for maximizing employment looks like it's baked in, it's okay. And now it's time for them to control the 7% interest rates that are really hitting the mums and dads and people across the US in the hip pocket right now. In fact, inflation is the number one political issue, number one issue, period, for the US right now, more than COVID itself. And it's political dynamite for Biden. Biden's putting the pressure on Jay Powell to actually hike the interest rates and get inflation under control, or Biden's going to lose the midterm elections coming up in November, right? So this is the number one issue, and it's such a big issue that, this is when Biden was calling that reporter a son of a bee. You know what I'm talking about. Now, I'll have to say that I have been going to the shops recently, the grocery stores, and I have been really alarmed. I think just last week, I went to do my groceries. It's insane. It's insane. I don't even live in the US, right? So imagine the US, if the fudged numbers are coming up at 7% inflation, which is huge already, right? Then the reality of it is more than double that. That's the level of inflation that's happening in the economy. So they have no choice but to raise interest rates. And so what is going to happen in the markets? I don't think, if you read the financial media, if you watch YouTube, they're not telling you the truth. They're not baking this in. They're not telling you what may be about to happen. If you're in the crypto space, you know what they're saying in the crypto space? They're saying, oh yeah, it's back above 40,000 for Bitcoin. Good stuff. You know what a bounce is, right? A dead cat bounce. You know that stocks go up and down and up and down and up and down before they eventually reach either fully up or fully down, the actual direction. I mean, I can show you a chart again right now, and you will see there are a lot of squiggly lines up and down that don't necessarily exactly tell you where it's going to go. It's only when you get more of those squiggly lines put together, then you go, oh yeah, the market's gone up. Oh yeah, the market's gone down. One squiggly line isn't going to tell the truth. Now, the other thing I want to mention that's really interesting is we had word from the Bank of England, just to show you how global this inflation issue is and what they're going to do to fight it, which in other words is crash the economy, right? Interest rates don't do anything to stop inflation unless the interest rates slow the economy slows, the demand slows. And so when demand is less, then you have less inflation, because inflation is a product of supply and demand. When demand exceeds supply, then we have inflation. So what you have to do is reduce the demand. And if you reduce the demand, that reduces the economy. So it's inevitable that we're going to have an economy that goes down. Now, Bank of England, I'm going to show you on screen. Bank of England calls for wage restraint to keep grip on inflation. So this is two Bank of England officials stressed on Friday the need for restraint on pay rises, drawing an icy reaction from unions and government, right? As they try to head off inflation running at 30-year highs by raising interest rates again. The UK has already raised interest rates. Now it has to look at another interest rate. And look how desperate they are. They're saying, oh, don't raise wages for people, for the plebs, right? Just, it's okay if the asset prices go up. It's okay if your grocery bill's up. But if we have your wage go up, that's the final straw. And I sort of understand that actually, because that really cements the inflation when the wages go up too. But this is unprecedented. This is how much of an emergency it is going on across the globe with inflation. It is a fire that the governments and the central banks are panicking to put out. They're really keen to put out. They're desperate to put out. I want to jump on another chart and another graph of the current inflation rates across the world. And this is the only way to stop the inflation, right? Let's look at the United States, 7% inflation. China, 1.5%. That's if you believe the numbers, because the economy isn't doing that well. So there may be some truth in that. The European Union area, Euro area, 5.1%. The ECB, Christine Lagarde just came on the ECB meeting the other day and said they may raise interest rates above negative, above zero, for the first time in more than half a decade. So, even the ECB is raising interest rates. This is a crazy world. This is a completely opposite world to the one we had in the last 5 years, let's say, especially the last 2 years. Easy money is gone. The money is going to be taken away. The punch bowl is going to be taken away. What's going to happen? Right? We look at Germany, 4.9%, the UK, 5.4%. That is huge. Right? I've been trading markets for so long. Anything over 2% is so unusual for these developed countries. Right? Look at India, 5.59%. It's all in the 5%. This is crazy numbers, right? Australia, 3.5%. That's if you believe it. I don't really believe that. Brazil, 10%. Russia, 8.4%. Turkey is suffering from basically hyperinflation. Lebanon, also hyperinflation. Inflation is going everywhere across the globe. What are we going to do about it? Or what's going to happen? I think right now, the safest place to go is not necessarily cash. I actually think the safest place is hard assets, because cash is going to go to trash with inflation, right? If they crash the stock prices, you may get a good bargain holding cash, or buy a property or something like that. It's deflationary with that reaction of cash. But if they do not crash the markets and the inflation just continues, you're holding a bag of bad stuff. You know what I'm saying? Dog poop, let's just say. So that's very dangerous to hold cash. Right now, for me, I'm just, because I can actually trade the market, I'm preparing to short the market. This is a classic sell the rip situation. I'm going to show you on the chart right now, selling the rip. And they say buy the dips and sell the rips. This is definitely a sell the rip situation, right? We're jumping on, and we can see that we've had a massive drop at early 2022, right here, and we just had a massive drop. And that momentum, I believe, will continue. We may see a few squiggly lines around the 50 or 100 moving average, these blue and green lines, which will provide good resistance. And you add into the fact, it's probably a few good round numbers right here. 4,600 would be a decent round number, or 4,500. Around this whole area is a level of resistance, and people are willing for all their gains sell out, right? And this is another place to think about shorting, right? Because they finally got an exit. Oh, it's gone back up. I can sell now. I can sell, right? I'm not selling at the lows at, let's say, 4,300 or 4,200. It's gone up to 45, 4,600. Okay, cool. I can sell. Great. That's what's going on. And Wall Street has already been planning the exits. I'm going to go to the chart again. 4,700 back in mid-November. Another one on the 13th of December. Around those days, they've been trying to sell out. And then one more pump to the highs to get all the retail excited. And they've been setting their orders to sell at 4,800 around, right? At the beginning, at the very the days of the new year, end of December, as well as early January. So that was the new high to suck all the retail investors in. Great. And then we have the crash. And you can tell Wall Street is all over this. I can tell because I trade the markets. I can read between the lines. That's what's been happening because Wall Street aren't idiots. They pay attention to the Federal Reserve even more than I do, and perhaps you do too. So we're ordinary people, relatively speaking. They're really on top of this. I don't believe for a moment that this is a truly buy this dip situation. Hey, I could be wrong. When something's truly obvious, sometimes they just go the opposite way. We have one more push to the highs and then we truly crash. That can always happen. But for me, I'm looking to short the market. And then we add in the fact, if we want to look at the smart money, right? Let's look at smart money. And smart money usually truly plays the bonds. And if we look at bonds, we're seeing just going to new lows, right? It's been crashing since 2022, or 2021, early 2021, late 2020, right? They knew the inflation was going up, right? For all of Wall Street talking about transitory inflation and all of the Federal Reserve and Central Bank saying transitory inflation, the smart money who truly know what's going on, have already been cashing out of their bonds, have already been pricing in high interest rates, high inflation since, you could probably say, October of 2020. They knew this was coming. And now we're reaching new lows. That does not tell you inflation or interest rates are going anywhere but up, right? So this idea that the market is going to get some sort of true rebound and go to new highs, the stock market that is, I truly don't believe that. And this is the game I'm playing, looking to buy the VIX. The VIX has crashed back to an average level, let's just say, right? But compared to 2020 when it went up to really high levels, it wasn't that. We're nowhere near that. We're relative bargain at 23 VIX. You buy a good ETF that tracks the VIX. Another drop, this is going to pop from maybe 22 to 40. You can double your money in a matter of weeks, maybe days, right? We can see. I don't know if you remember trading in 2020 or any of the crash times, but you would have limit down days where the stock market would not let you trade because it's crashed so much. Now, I'm not predicting those, but I would say if I saw that in the next couple of weeks, I would not be surprised. Anyway, that's my take on the market. I hope you enjoyed this finance focused video today. It's not so much geopolitics, it's full on finance. And I hope you enjoyed it. And if you are invested in the stock market, I'm not going to give financial advice. I will say just be very careful, diversify your risks, be very conscious of your risk appetite, and hopefully you haven't been carried away with some of this. I mean, for me, I'm a big fan of Palantir for the technology in there, and I bought some stock last year, and that's gone underwater. That happens. But it's only a small fraction of my portfolio, and I've got other things too that have been doing better, faring better. So the wild 2021 last year of all the GameStop and AMC and Tesla and all the crazy retail, Bitcoin to the moon stuff, I think that period is over. And I think the crypto bull run is also potentially over. It's all dependent on these interest rates coming up. Anyway, that's my video. Like If you liked it, subscribe. If you really loved it, I'll catch you in the next one. Share. Thank you then. See you then. Bye.